Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, May 10th, 2024. S&P 500 currently sitting at 5216. I'm David Zarling. I'm here with Ian, Higher Highs and Higher Lows McMillan. Why fight the trend, Ian?
It's tough. Hey, it takes a lot of emotional. I think at this point, if you're fighting it, probably some type of bias there.
Yeah, if you're fighting the trend and the trend is up, you're probably focused on a narrative that could be true, but it might be true. It might come to fruition from a price perspective 3 years from now.
Well, and I would say the April weakness from a timing perspective, also, from a technical perspective, of course, got the, oh my gosh, this is it crowd riled up again to no fruition so far.
Yeah.
So again, we've talked about it week after week for months at this point, upward sloping 200-day. Dave's mentioned that 200-day should actually, that slope of that should get stronger based on what's dropping off.
Yep.
And we know you can zoom out over 100, 150 years since the stock market opened its doors. That is a really tough time to bet against stocks. And you're much better off erring to the side that this probably ends up going higher.
Momentum is a tricky thing. It's really not, but it's tricky for narratives and for biases.
Yeah, and when momentum stops momenting at the same pace or the same rate of trend, even though the trend might still be up, people get antsy.
Mm-hmm.
I think we're also in a pretty long period where there's a lot of anxiety and discontent with the average American and what their weekly or monthly finances look like. Talked about that. I would say that goes for all income classes. Again, I don't know anyone that has gone to the grocery store and hasn't noticed the difference. But to many people, that type of anguish leads them to believe that should follow through to the broad economy or the stock market. If I'm feeling this, clearly everyone is, and clearly that's got to be bad for companies, right?
Yeah.
It's got to be bad. And if it's bad for companies, well, then that definitely should show up in the stock price.
Mm-hmm.
And that's just not the way things work.
The market is a future discounting mechanism. It also is one of the reasons why we're involved with markets is that it protects purchasing power, which what are we really saying when we say protect purchasing power? It's from the degradation that happens from inflation. So one of the reasons why investors, or at least why investors, one of the reasons they should be involved with markets is because of inflation, is that it's a method for protecting the dollar that you've saved, that you've earned, that you're now going to spend to whether it's travel, healthcare, you name it. It's about protecting that purchasing power. It's not about entertainment. It's not about something being fun. And that can be confusing to some because in the end, increased input costs to companies, where do those end up? To the consumer. It gets passed along. And therefore, yes, inflation is alive and well and in the face of consumers, but it also is why you're involved with markets is to protect that purchasing power.
And you've been harping on that, Dave, since
episode 1.
We had a lunch and learn in like early 2022 when all of this inflation stuff was starting to pick up. I remember, as weird as it sounds, probably going to want to be involved in equities over the long term, right? They're just another thing denominated in dollars.
Correct. Like if you sit in dollars, it's where you get hurt the most. Well, I should be clear. You might sit in a foreign currency and be hurt even worse. For Americans, for most, if you're sitting in dollars, it's the easiest thing to sit in. You would be hurt the most. And what the last 5 to 6 months have been indicative of that. If you didn't use technical analysis to identify when demand is outpacing supply, you didn't participate in this. And what a shame.
No, because if you were approaching it with some big macro view, check all the boxes of the horrible things that are happening in the world and our economy. Why on earth would stocks go higher? I mean, pages and Substack articles worth of all the things that are wrong, Dave.
Yeah.
So many things, so many bad things in the world. And there's absolutely companies, stocks can go higher.
It goes back to your comments in episodes past about the wall of worry. We have many bricks right now.
Oh, gosh. So, we've added.
Inflation is just one big one that's glaring, but you could name a number. Election, Ukraine, Middle East, employment or unemployment.
Yeah. Interest rates, housing prices.
They're all there.
And I'm not saying that people are wrong. Like, people aren't lying. Housing prices are clearly up. Hamburgers, ground beef, clearly up. Average person probably upset with a lot of things going on in this country right now. That's not to say that you shouldn't feel those ways about those things in a silo. And again, it has nothing to do with what stocks may or may not do.
It seems to be the consistent characteristic of the market in its interaction with human opinions. So not only are human opinions interlinked with price, right? Because all opinions are reflected in price. But if you are an individual thinking outside of that opinion, so I talk about the jelly bean experiment, right? Like you go and make a guess on how many jelly beans are in the jelly bean jar. Well, research shows us that the average of all the guesses is closer to the accurate amount versus the individual. So there are times when an individual is completely out of the norm, but the average of the whole is closer to the norm. And what I mean is, for some, their individual opinion based on the news that's been fed to them makes them feel like the market can't be doing this. Even though the market is the market, it is what it is. It's looking out 6 to 18 months in the future. Who are we to argue with? It feels like you're standing on the beach screaming at the ocean. Ocean doesn't care what you think. Markets don't care what you think.
And how many times do we talk about every year there's multiple, oh my gosh, this hasn't happened in 5 decades.
It's always like that.
Yeah. Oh my gosh, this happened and we have never seen it.
Once in 100-year events every year. And that's statistically known as fat tails. That's just the world we live in. We've talked about the weather comparison in the past. Like if you look at the weather in the Carolinas where you live, Ian, like how often does a once in 100-year event happen? Well, once in 100 years. But if we look globally, there's always a once in 100-year event happening globally.
Yeah.
Every year.
Somewhere, some asset class, sugar, right? I could put that on there so far.
Cocoa.
Yeah. Or cocoa. Yeah.
And honestly, Ian, when you look at the data for the period of November through March in this market, that move in equities over that time frame is a 1%. That happens 1% of the time. But the 1% happens more frequently than a normal distribution. I would make the argument that's life. Like the markets mimic nature and life, and abnormal happens normally. Markets are certainly. Inconsistency is consistent. Like, and this is the hard part. That's the hard part of markets, but you should be involved with them when it's appropriate to be involved with them. And right now is one of those times. We have a rising 200-day. The past 200 days of information is rising, of demand outpacing supply.
I mean, you get a hot water heater with a 20-year warranty and it craps out in 3 years. We can say, don't worry, hon, we're not getting a new hot water heater because this has a 25-year warranty. It should start working again. We just got to give it some time. Does it sound crazy? Yeah, but you kind of just got to accept, just like the market, you just got to accept what's happened. Whether it feels crazy, whether it's a rare event, whether you're annoyed that you are positioned wrong, it is what it is. Things that shouldn't happen. And I'd rather just change my opinion. I'd just rather sell at a small loss before I turn it into a big loss. I'd rather just eat it and get a new hot water heater so Move on to the next one.
Well, and we have to remember that sometimes as investors, we view markets through our own lens as an individual investor, rather than understanding that we are going into an extremely competitive field, right? There's evaluations and opinions that are being matched against some of the best minds in business by institutions, right? There's a massive spectrum of investable securities, and all of them are intense study by men and women who, like, their economic survival depends on their best judgment. And so therefore they're putting millions to billions of dollars to work, and that impacts price. And some might say, oh, that's an unfair vote. I've got $1 and this guy's investing 1,000. It's life. And the $1,000 is going to move price more than $1. But why fight the trend?
More.
Why fight the trend though?
There are people in this game and their opinion just happens to matter more. Sorry to bust your egotistical bubble.
It's not an irony. It's just a truth that if that dollar is more successful in identifying trend, the more dollars you will have and the more your opinion matters. There's so many market participants, institutions. We're talking about, investment banks, RIAs, endowments and foundations. These are billion-dollar, some are trillion-dollar firms, and the ideas and opinions and all of those will be involved. And there has to be some market philosophy or like a decision framework. And that's where technical analysis comes in. Like, how are we able to tell good opinions from bad opinions or wise judgments from unsound judgments? Because if the market's in an uptrend, but we have an opinion that the market shouldn't be doing that, who is really wrong? Is the market wrong? Are we really that arrogant that the market is wrong?
What are you going to do? Stand back and say, well, yeah, the market was up 25% this year and I was up 0, but that's because the market. I mean, imagine saying that to someone. Imagine walking to a group of people and saying the market was wrong.
That's so arrogant. So arrogant.
Is there anything? So when you look at market internals, is there anything that's been a hot topic, even if it's from the technicians, that you would put in the... Well, right, so we're talking about technicians and trend following, but I would say there's things underneath the surface that have people worried. I'm not really convinced about it.
I think the performance of utilities year to date and on a relative basis has piqued the interest of those. Now, I'm not here talking about Mr. and Mrs. Client who enjoys traveling and gardening and hunting over their free time. That's not who I'm talking about here. They're not sitting there worried about utilities. They're just not.
No.
But from an industry internal perspective, there are some who are like, wow, look at what utilities are doing year to date. Well, okay, let's talk about that again. Like utilities, first of all, why would that be a perception of some in the industry from a standpoint of being a warning sign or some type of red flag to keeping the context in line as far as what we've seen over the past 3 years from utilities, as well as being market historians and understanding past market environments? I'll let you elaborate on that.
I'm just not stressed over utilities doing anything. They're going up. The broad market's going up. Owning Wisconsin Electric, not as sexy as owning Microsoft, right. But I don't know what to tell you. And so if broad indices were going down and utilities were going down less, fine. Let's put it in the worry box for sure. Willing to sign off on that. But broad markets going up and utilities going up more, in both scenarios that are outperforming, like I just don't care. I mean, it just doesn't bother me. Who cares? They're both going up.
Well, and utilities have been on a relative downtrend for, I'm not going to use the term ages, but basically since the end of the financial crisis in 2009, early 2009, you're talking about a sector when compared to the S&P 500 that's down 66%. Like, let's not lose our mind over something that's started since March of this year. You're talking about a 2-month perspective.
Well, then how can you say, like, this is where people really lose me when they claim, oh, well, utilities can outperform in a bull market. This is a warning sign. Clearly, you haven't looked at a chart that
Yes.
goes back more than 10 years.
Yeah, you're
So
pretty
maybe
young.
sit this one out. And yeah, like it can happen. 03 to 07. Utilities up over 200%. I think the S&P was up somewhere in like the 70s over those 4 years, like 75, 76 maybe. I can't remember if that includes dividends or not. But I'm telling you, we went on a 4-year stretch where utilities beat the pants off of the S&P. Were you going to tell me that that wasn't a market we should have been involved in because utilities were leading?
Your point is spot on. You're just saying we had a 5-year period where utilities outperformed. The market did just fine. So what are we complaining about here?
Yeah. People have such recency bias. You know, people that have gotten into the market over the last 10, 15 years, which, I mean, that does include me. You know, I graduated college, but I know how to zoom out on a freaking chart and say, well, has this actually happened before or not?
Right.
And it has.
It has.
And again, I'm not willing to sit and say, I'm not willing to tell my spouse, I'm not willing to tell my boss, I'm not willing to tell my clients that, hey, we just missed out on a massive multi-year wealth creation event because I was nervous because utilities were outperforming. Not going to do that. I'll tell you that right now.
Oh, for sure. And if utilities are going to outperform foreseeable future, like a 5-year period, we're early. Like, let's not get ahead of ourselves here. This was at this point, the thesis of a reversion to the mean is intact. When you take a look at XLU versus S&P, we're back to just above a 200-day moving, a declining 200-day moving average. Now, do we base out here and utilities move higher? Maybe. And that's cool. We'll participate. But for years on end, that's not been the case. I think part of it is because sometimes we take intermarket analysis too far. Intermarket analysis is important, but sometimes you take it too far and you lump utilities in with defensives. And that's not always the case. Like, I understand that you would lump utilities in with staples, with real estate.
They're lower beta, right? Lower beta. No one wants to be involved in them when stocks are going higher, or that's been the mantra for 14 years. I get it. Doesn't mean it can't happen.
Exactly. And so while people want to lump them in with defensives, that may be true. But
well,
also
then let's talk about it. Then we got to talk about all defensives.
Right. Then we have to talk about all defensives. So what are we seeing out of staples?
Nothing that worries me. Same with real estate. I mean, have staples outperformed since mid-April? Yeah.
But within the context of a major downtrend on a relative basis, like we're not sitting here like, oh, this is it. This is the start of a market correction and staples.
And since broad markets have started going higher, they've fallen off.
Mm-hmm. Now, there's nothing saying that this few week rebound in stocks doesn't resolve lower the rest of the month and into July. That's not what we're talking about here. We're talking about major trends. We're not talking about near-term trends. We could obviously see the equity market as defined by the S&P 500, that this period of time is very similar, could be, don't know, but very similar to the rebound we saw in August of 2023, and then stocks move lower.
Yeah.
I'm not here to tell the market what to do. So is this just a bounce before we move lower into June and July? It absolutely could be. But when we step back and look at the big picture, even that type of move, let's say we move lower into May and June, we'd be moving into a rising 200-day moving average. We'd be moving into like a 4,800, 4,900. And that would be perfectly normal from a seasonal perspective heading into the final part of the year. And meanwhile, people are going to get caught owning utilities during that 1 month move and then have that opportunity cost on their hands for the second part of the year. I do find, go ahead.
No, you go ahead. Sorry, I forgot what I was going to say.
That's okay. What I was going to say is just what's interesting about utilities is there's other areas in the market that when we talk about that 03 to 08 period, it makes you sit up and be like, okay, there might be a thesis here with, for example, miners, like gold miners.
Miners, man. Yeah.
Like, can
And
you elaborate on?
well, that's the
what was
other
said?
thing that people want to correlate. They want to look at gold and say, oh my God, people are buying gold. They must be so scared about stocks. That's not true. That's not how this works. Now, gold might outperform. That does not mean, oh crap, people are scared. It just doesn't. There's nothing that says that to me.
Okay, let's say this is
I mean,
030.
why didn't gold spike in February of 2020 and went
Yeah.
down with all the stocks?
They sold everything. Okay, let's say this is another 03 to 05 period where utilities outperform. You know what else outperformed during that period? Miners. Your
Miners.
precious metal miners, industrial metal miners.
Gold was down for all of 2022. We had a massive bear market. Why didn't people rush to gold? They were so freaking scared. So
Yeah, it
this
doesn't-
is just not a practical. When people say that, it's not backed up by anything throughout history, recent or long term.
It makes sense on the surface, but when you really dig down and as a market historian, you study the charts using technical analysis, you see, oh wait, there are periods where stocks are down and gold is down. Oh wait, there's periods where the market is up, but utilities are up more, and these things ebb and flow. Like correlations do not stay at 1 or -1 forever. It's an ebb and flow. And what's interesting is if we are to see utilities continue higher on a relative basis, if we are to see mining, gold mining, silver mining, copper mining, precious metal and industrial mining move higher, well, isn't that interesting that it matches some of the things we're seeing internationally? Because 03 to 08 saw utilities outperform, miners outperform, international outperform.
Yeah, emerging markets were amazing.
So it's possible. And when we talk about, on the past on here, Ian, we've talked about how sometimes the launch a certain type of ETFs, like a thematic or a subsector, sub-industry, can sometimes coincide with the top. What's interesting is you brought up before the show, GLD, right? The launch of one of the most famous gold ETFs was at a proper time. It's when gold outperformed.
Mm-hmm.
Same thing with, I believe, GDX. Same thing with emerging markets, EEM. These ETFs were launched. They moved aggressively higher. They were launched at great timing. Not that they knew it was great timing, but it matched what was going on thematically. And here we've just launched we haven't, but the industry has 2 new copper ETFs, copper mining ETFs, junior copper miners, something outside of COPEX. Are we on the verge of seeing copper move higher? Because when you look underneath the surface, like Dr. Copper, and you look at copper itself, copper miners, Freeport-McMoRan, there's something going on.
And having another strong day. Well, up today. A little bit off the highs.
It's interesting that you could have this dynamic of, and the other thing is, you don't just get to say, oh, it's high beta and low vol. So think about what we just talked about. Utilities, low vol, miners, high beta, moving in unison from 03 to 08.
Yeah, it's a good point. It's a very good point.
You consistently cannot put them in a box. People like to say the phrase internet is undefeated. Markets are undefeated. Period. And the sooner we understand that no more can I control the internet, or does the internet care about my opinion? Same thing with markets. I cannot control the markets. Markets don't care about my opinion, but we can participate in them. It's beautiful. It's wonderful. It's America. We could, think about it. I've got 3 or 4 different copper mining ETFs that I can choose from. That's nuts. That's insane. I can go buy Germany. I can go buy German equities using an ETF.
You can also buy Hedge Germany.
Yeah. That's huge.
Which is basically the DAX.
Do you see what I did there? I was trying.
That was good.
Yeah, that was dad
That was
joke.
good.
My daughter.
I don't know how many other people will get that.
Yeah, my daughters give me a hard time. But anyway, what we do know is that Germany, on a euro basis, not dollar basis, Germany doing very well. And it's highly correlated to U.S. markets. So if
look at VGK. Europe beat S&P to new highs. I just don't tell me where you're going home today with that information and saying, yeah, things are looking a little rocky.
How does European financials doing well bode negative for the market?
Yeah, you've seen European financials versus American financials. Europeans have won that battle, I'll tell you that, so far this year.
And how negative can that be? And that's a rate of trend that goes back that we broke in 2022. So coming out of the market bottom in 2022,
Yeah.
the area that's on a relative basis that is worth sitting up and being like, is European financials versus large cap US financials. Well, how negative is this market environment with that scenario on our hands? If we've got the DAX moving to new highs, we've got European financials outpacing American financials, that's not risk off behavior. And so don't sit there. And if we know as market historians that utilities outperform it for 5 years in a bull market, I think your point, Ian, is how can you sit there and say that utilities outperforming is a negative thing?
You can't sit there and make the argument that both are going up, but yet we're in a bear market. You just can't.
Right. By very definition, we're not. We continue to make higher highs and higher lows. We've got a rising 200-day moving average.
What about bonds? Are you ready to buy bonds? You ready to go all in on duration, Dave?
What's interesting about that is looking at international bonds versus U.S. bonds. So when you think about the risk spectrum, so like think about this line of risk, your most safe in theory is carrying cash, getting some type of yield. Your most aggressive is, some really small energy company in somewhere in the Southern Sahara. I don't know. But the point being that from a risk spectrum perspective, fact that emerging market bonds are outpacing U.S. treasuries reeks of risk taking. I don't know how we can say it any other way. Like, we're willing to buy.
I think people want to see it all line up perfectly. You and I know that that'll never happen. Mm-hmm. You can build a checklist, whatever you want to see, and very rarely are you going to have all those boxes checked and say, okay, now I'm ready to invest, because everything's lined up perfectly for what I view as important.
And markets will never be an all boxes checked scenario. It's weight of evidence. It's this versus that. On the one hand, you have emerging market bonds outpacing U.S. bonds. On the other hand, do you have some very, very near-term, small time frame outperformance by quote-unquote defensive sectors, with one of them being utilities, but sometimes utilities is an offensive sector. So everything's got to be taken with an understanding of market history and how market dynamics change. We've talked on here several times, Ian, about if we are in a new paradigm, a new 40-year cycle for interest rates, what type of relationships will change? What type of relationships will be different than what most investors are used to over the past 40 years? A lot. There'll be a lot of different things.
Yeah, a lot of different things. So many relationships and correlations and, beliefs, strategies, that branch off a 30, 40-year falling rate environment are just going to be tossed out the window.
Mm-hmm.
I mean, how many people alive were managing money in the late 70s?
Right. Which was another inflationary environment. It was the peak of the interest rate cycle.
I guess you should say still managing. I'm sure a lot of those people are alive.
Oh, yeah.
But
right.
A very few of those people are still managing assets, falling rates, just debt getting cheaper, kind of a Goldilocks scenario that for the 100th time, I'm going to say, has likely come to an end.
And yet here you have an environment where microcaps using IWC are above its volume weighted average price from its all-time highs back in November of 2021. You have foreign equities, even foreign financials, foreign credit, junk bonds. Like, if you want to check boxes, if you ever look at it from this angle, from a risk-taking behavior, we're checking a lot of boxes for risk-taking behavior.
Yeah, like what's wrong with junk bonds versus 10-year treasuries? What's wrong with that chart? People will tell you credit markets are stressed. I'm telling you that they're not. They're just not.
Right. We remain in this triple C. We've talked about triple B credit. We've talked about triple C credit, this environment of higher risk bonds. or credit, we still remain below a 200-day moving average that's declining. Now, we've perked up recently. Could we see that option adjusted spread for junk credit, triple C's move higher at this point and equities move lower? Yes. It might not be on the time frame that everybody's expecting, meaning we're just talking about the near term, a couple weeks. We're not talking about the long term. When you look at some of the things that are developing long term, even with like emerging markets or VEU. So we had a little bit of an interruption technology-wise here in-house, but we were talking about credit spreads, talking about how we're still below a falling 200-day moving average. It could move higher. Perfectly would be something to pay attention to. But from a thesis standpoint of what does risk off look like, Ian, is there anything you can elaborate there where we would be paying attention to if these certain things?
Again, we got to go back to big picture. Two things. Breadth thrust, November, and we're above 4,800. And so I'm just not worried. Like, I could point to the weakness in high yield spreads coming from energy, which have been weak they haven't really bounced. But I am willing to bet if they eventually do bounce here, where I'm looking at XLE, that would actually be a pretty solid risk reward spot. If energy moves higher from here, just don't be surprised if those spreads come back down.
And meanwhile, we continue to see junk outpace 10-year duration, 7 to 10-year duration of U.S. equity, and we continue to see emerging market credit outperform U.S. credit. So there's a couple of ways to view that. What lens you're viewing that? Is this 2011 where you see a U.S. debt downgrade? I have no idea. But on the flip side, it's a risk-taking market. We continue to see risk-taking pieces of information, such as microcaps, such as international, such as European financials, the DAX, German equities, the Nikkei, Japanese equities. So developed markets internationally, emerging markets internationally, gold miners, like these are high beta risk-taking areas of the market. That doesn't preclude or say that we can't have another September and October of 2023 where we're correcting another 7% down into a 200-day moving average. That could absolutely happen. Not here to tell the market what to do. But from a really big picture perspective, because let's be honest with each other, everybody listening to this, 2 months is not a market. Like, we don't get to sit here and be like, oh my goodness, the next 2 months we've corrected, it's all over. No, we're in a counter trend move, perfectly normal with an uptrend that's upon us. I may have taken some of your steam there, Ian. I didn't know if there's other things that you're looking at that would say, hey, our thesis is not on point anymore. The thesis being a upward moving trajectory for U.S. markets, international markets, risk-taking behavior. Are there other things that you might be looking at that say, hey, the thesis on this is wrong. The thesis is outdated and we need to be protecting? Are there price levels in areas that you're looking at where that would preclude taking some protective action?
I mean, high beta versus low vol hasn't fallen off again. Not that that can't happen. Outside of price, there's just not a lot that has me staring at my ceiling at night, wondering, was today the top?
Well, it gets really hard when we know the concept of momentum. We understand that momentum is a factor that is in markets, and in momentum can go both ways. Momentum can exist in an uptrend, right? Higher prices beget higher prices. And so, for example, in a market environment where we're establishing new highs, which we didn't establish a new high, I want to remind everybody, we didn't establish a new high until January of 2024 of this year. We're 5 months into new highs. We hadn't gone anywhere, 0% return from early 2024 back to early 2022. So average return of the stock market using the S&P 500 is somewhere between 8 and 9%. We went nowhere from January 22 through January 2024. And so here we are in a pullback or a rebound off of a pullback. We haven't eclipsed. We haven't passed back through that 4,800 level to the downside. And so here we have an uptrend on our hands, and any type of consolidation at this point, frankly, would be welcome.
Yeah.
It's okay based off of the last 5 to 6 months of data. And as you have appropriately highlighted in the past, let's not forget what we saw in November of 2023, which was historic breadth thrusts and price thrusts that have these magnificent 12 and 18-month return characteristics. And here we are only 6 months removed.
Yeah. We get all excited about these forward-looking returns when something happens. And we say, oh, wow, look how good stocks should do over the next 6, 12, 18, 24 months. And then we go right back to worrying about our 5-minute charts and what happened on this. Why does this candle look bad? And I mean, I've been guilty of it too, but certainly much less so. You've got the wind at your back. Just don't overthink this one.
Well, and we highlighted momentum. I always like touching base on the supporter of this podcast, which is the Adaptive Select ETF, which is listed on the NYSE under ticker ADPV. Adaptive Select helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. We haven't reached the end of our time. We could take this anywhere we want.
So I will take this, Dave, somewhere. Okay. But real quick, I would add that anecdotally, you asked before about relationships or things, and I'm going to add that, there were signs end of March, going into the first week of April, to things we might take a short-term break. And ADPV, it's in the left lane. It's a left lane vehicle. It's gonna run pretty hard. But ADPV outperforming during the correction, I think, is a pretty good sign for momentum in general, and 2, for the broad market.
When you use ratio analysis, it's about identifying that relative strength. So an example of this would be, so we corrected in the market from early April through now. What are those things that are now above their April highs? Well, ADPV is one of those. And so you sit there and go, okay, momentum is still healthy in this market. So how negative is the market environment if momentum is still healthy? I think that's where you're going with this.
Yeah.
And I would encourage any investor that shouldn't we be looking at where the strength is in a down tape? Meaning when we see a red tape, we see a red April, where's the strength? Well, if momentum is strong during that, how negative can things be? That's just a beach ball that's been pushed underwater. Does momentum just continue on? And there's other parts of the market that are like that as well, that they're back above April highs, and that's where you want to be paying attention. Who's above their April highs? And that is where you would start. I think that's what you're referencing here. Is that
absolutely? Yeah, I would say other areas of the market that are doing that are some of those things we've mentioned. Gold miners above their April highs. You mentioned the DAX.
Yep.
Boats, so like shipping.
Yeah.
Very strong move. So yeah, there are areas, right? Because the S&P isn't back to new highs, but we know the S&P is just a massive average of a bunch of stocks.
Yes, it's the average.
So there's likely that there are stocks that have already made it back, and a lot of foreign areas, and not just gold, silver. They got a lot of attention, but platinum.
Some of the industrial areas are above their April highs. And so are we aerospace and defense? Are we sitting there and saying like the most aggressive areas of industrials are above their April highs, that somehow the market's
Greece? I'm telling you, Greece is above its April highs. Try not to have a crappy weekend worrying about stocks. I'm telling you, The time will come. It ain't now.
Right. And sit back and enjoy it. Right.
Italy, new above April highs. It's not time to stress yet.
Don't stress yourself and mess yourself when we've got these different areas that are.
China's been on a strong run.
Yeah. At some point, you just have to shut up and enjoy it. Like, we're in an uptrend. There's certain areas that are strong. It's areas that reek of risk taking. And I'm not saying that these 5 to 7% corrective moves, maybe even 10% corrective moves, let's say we roll back over and head into June and July and correct into a 200-day moving average. I'm not saying that's not uncomfortable, but it's the reality of markets. And here we have all these different signposts, things that you would see in a market that are like, yeah, this is pretty doggone healthy market. And we haven't even had the secondary move of breadth expansion upon us. And we're just sitting here waiting. It could happen, doesn't have to happen. Really, since mid-January, breadth has been lukewarm. It's not been this dramatic, all hands on deck, all stocks are moving higher event. And that's still sitting there.
Absolutely agree with that. November, December, we had our breadth thrust. Things separated since then in a very healthy manner. And how many people are looking over their shoulder for a weak summer? It'll be interesting to see how it plays out.
It will. In the end, that's all we can do is wait for price to come in. Does it match the thesis? Does it not? That's using a weight of evidence approach. That's not using a somehow my brain is smarter than someone else's brain approach. It's using the weight of evidence. It's using the jelly bean experiment. It's understanding that markets are a future discounting mechanism. And right now we have an uptrend on our hands. Let's use that lens rather than the lens of somehow the interest rate that the Fed sets or non-farm payrolls or some GDP number has a today effect. It's about 6 to 18 months from now. We're up against the end of our time. Anything else you'd like to highlight before we wrap it up?
Nope, nothing from me.
All right, excellent. We appreciate everybody listening. If you like these, make sure you share them. Give us a thumbs up, high ranking, however you want to do that. We love that you guys listen. It affirms what we're doing. We hope you guys appreciate the information. Ian, thanks for being on here with me again. Always do a great job. Thanks, everybody.
Have a great weekend, everyone.